Welcome to the technical brief, ladies and gentlemen. Why did I say lady, not ladies, Nick? Is it just because we have one female viewer? Anyway, let's do that again. Welcome to the technical brief, ladies and gentlemen, to the new issue of the Grey Market Talk between Thorsten Wegener, who's obviously a little bit confused today, and Nick Themistocles, who's never confused and used to manage and still manages lots and lots of money. I can't even fathom because I can't handle the truth. Can you handle the truth, Nick? Nick, thank you very much for your time.
Good morning, Thorsten. You're welcome.
We had a conversation earlier. Yesterday, I had a fantastic show with Marcus recorded, 1 hour, 15 minutes, and I thought it recorded. It didn't, so I'm going to shoot that later again. So let's see how this works. Nick, you've reminded me, press the bloody record button. I did.
Absolutely.
And let's get into the material. I'm trying to share my screen. What are we going to do today? Share. Nick, can you see it?
I can see that.
Good. Grey Market Talk, the 12th of November. That is, Armistice Day was yesterday in the UK, right? Today we have, what's the official name of it? Remembrance Sunday.
Indeed. It's also my brother's birthday. Happy birthday, Tim.
Excellent. Happy birthday, Tim, from my side as well. So what are we talking about? Thoughts from abroad. And I called it Being the Best. Last week, we only had a slight absurdity of the week, but I couldn't do it that short this week, Nick. There's too much crap going on. I have to put an eye on it. And one of the things that really caught me was this Orwellian piece of news in the German papers. They are discussing a new law in Germany, and my former political affiliation, the Liberal Democrats, which is not in American sense liberal free market thinkers, who are not any longer free market thinkers, but part of the government. And they said, nah, even we are not happy with it. So I put it into DeepL to get the proper translation. But just for the fun of it, if you like a German hard accent, it's called the Gesetz zur Stärkung von Maßnahmen zur Demokratieförderung, Vielgestaltung, Extremismus, Prevention und politischer Bildung. Translation is law to strengthen measures for the promotion of democracy, diversity, prevention of extremism, and political education. The funny thing is, the word diversity we use in Germany at the moment as well. They deliberately kept it out and used the German translation for it, or what it means. So this law to strengthen measures for the promotion of democracy, like in the United States, I've noticed now for, I don't know, 20, 25 years, the title is always the complete opposite of what they're really trying to achieve. Yeah? So if we go pick that apart, piece by piece, promotion of democracy, at the same time we read in the newspapers, the Alternative for Deutschland, the so-called right-wingers in Thuringia, one of the German states, is now in the majority. And there is the likelihood that they could get at the next election, whenever that happens, 1 year, 2 years' time, that they could get an outright majority. Immediately, the news comes up that the German equivalent, what's the Verfassungsschutz in England, MI5 or MI6, is having a closer look at them, whether they are against the Constitution, against the freedoms the Constitution provides. So they want to forbid them, yeah, simply to get them out of the way. So that's promotion of democracy. Diversity is, I have a slide later to show the madness, is obviously, we have now this huge conversation in Germany started. Are we taking too many refugees in? And what's their contribution to society? And can we afford that further into the future? Very interesting. So the majority of the population thinks we have enough provided for refugees, especially for the Ukrainians. Yeah, they are direct neighbors. There's a war going on. Of course, you take your Ukrainian neighbors in and say, fine, stay with us as long as this shit's going on. But that's not what people are worrying about. They are worrying about refugees who come for purely economical reasons, which is actually not provided by the law, but they still take people in. And that is causing a lot of problems. And the government is now arguing, yeah, okay, until 2030, we need about 7 million qualified workers in Germany. Apparently, Germans don't procreate, recreate, reproduce, which is true in a way. But that would mean every year another million people coming in. The interesting thought behind that is, Nick, whenever, and you have a lot of colleagues from all sorts of ethnicities who are at times in the city working. Yeah? So the so-called brown people, They laugh in my face. They ask me, Torsten, how long are you staying in Germany? When I say, oh, wouldn't you consider taking a high-powered job in a German bank or something? They laugh in your face. They say, no, not with your taxes, not with your bureaucracy, not with the way your country is run at the moment. It doesn't make any sense. Why would I come to bloody Germany? You should leave Germany. Come to India. Visit us. Actually, something I might consider in the future. So if they get their ducks more in a row than they already do, and Germany is doing what it's doing, not nice. Anyway, so prevention of extremism, a very interesting point we have going on at the moment. If you listen to the news or read the news, you see that our fellow Jewish citizens are getting problems in Germany on the streets. You can't wear a kippah anymore in Frankfurt. You have to be afraid. There could be something going on, and we all know this is, at least we know, the people on the street know, this is not German Nazis goose-stepping down the road and being anti-Jewish again. We've learned our lesson, but it is the extremism we have imported from countries who do not like Jewish people or Israelis. Let's call it whatever you want to call it. The problem with this whole thing is our government, every time a Jew is harassed or threatened or violently attacked, our Secretary for the Interior, Mrs. Faeser, goes out and puts it in the statistic as a right-wing crime, as a Nazi crime. Complete and utter bullshit. Huh? It makes everybody angry. And then obviously, because it still makes people angry, the last thing they had to slip in is political education. We all know when we hear political education, we think Soviet Union, we think China, we think Vietnam, we think the Khmer Rouge, we think North Korea. So even my former boys at the FDP, the liberals, think that might be a little bit too streamlined into a direction which moves us into, well, nasty socialism, where the ruling classes do not like their people anymore. Bertolt Brecht once said, famous German novelist, well, if the government doesn't like the people anymore, then they have to simply elect new people, not the other way around. That's where we have started now. So that all leads me to, meanwhile in Germany, what you see here on the map is the proficiency rate of reading for pupils in the 9th form. 9th form is when you're 15, 16. In Germany, we have a education system where you could leave school with 15, 16 after the 9th form and start a trade. Or you could stay a year longer. Then you have a different kind of apprenticeship, a little bit more on the theoretical side. Or you do your A-levels, your Abitur, and go to university or start something then. So that's the lowest level of the educational scheme. And I grew up in Germany. We were next to Japan and the United Kingdom at the time, one of the most literate countries in the world. I think only the Vatican was better, but they don't have really pupils over there. So, and now, if you look at these maps, you see the rates. Why are they at the levels we see here at the moment? That proficiency rates are lacking 37% of the pupils in Hesse are not proficient in reading at the age of 15, 16. Yes, it's an enormous influx of immigrants into Germany who do not speak the language, obviously have problems, but we have this huge influx since 2015. That's now 8 years further down the line. Wouldn't you assume that our educational system would be able to provide proficient reading, writing, math skills? So I'm not bashing the foreigners who are coming in. I'm bashing an educational system which obviously is completely and utterly not achieving what it's supposed to achieve. Fast forwarding that into the future, it's not a pretty sight. So then Germany in trade, a chart Nic and I had a good laugh before we started recording about. Our friends from Macrohive published that this week, and I couldn't believe it. What it shows you is the exports from Brazil versus Germany into China, which used to be our biggest trading partner. And Germany used to export automotives and auto parts, machinery and industrial equipment, chemicals and pharmaceuticals, electronics and electric equipment, and luxury goods and engineering services. The interesting thing about it is, I think we still all export that, Nick, but we also started, well, fuck it, we also sent the factories over as well. We don't have to do it in Germany anymore. That's what this chart shows you.
And also, I must say, obviously, you know, the likes of Brazil, part of the BRICS, and also a growing emerging market, frankly. So their growth is explainable. What's not explainable is the decline in German exports, unless you are mixing the business model of Germany with foreign policy. And the powers that be don't want to get so close to some of Germany's largest customers, like China. And if at the same time you're trying to sell automobiles, industrial equipment, blah, blah, to the Chinese, you are criticizing them, then don't expect to sell too many of this stuff. So you're destroying your own business model, and that's part of the reason as well.
Think about the earlier chart, education, yeah? Germany didn't have any resources, yeah? We had a bit of coal to keep us warm after the Second World War, but that was pretty much it. How was Germany able to rebuild that fast after it was completely and utterly destroyed after the Second World War? It was the educational part. People still had an education, yeah? And by losing a war and being bumped back into the Stone Age, you can't take that away. So we're destroying this at the moment. While in Brazil, I think our educational system might, I'm not sure about that anymore, might still be better than the Brazilian educational system. However, you can't take their fertile soil away. You can't take away their soybeans, their iron ore, their crude oil, their meat products, their wood and pulp products. Of course they are better. If we are destroying ourselves right now, yeah. The last time I think our trade deficit had come down from, I want to say with China, I want to say 50, 60 billion in 2015 to 5 billion. Yeah, absolute killer already. And what we can see here, if you just listen to us, is Brazil has crossed the line to Germany. They're exporting now more into China than Germany does. Germany apparently still being the powerhouse in Europe, or at least the biggest economy. It's sheer unbelievable, yeah. So didn't want to bang on too much. Meanwhile, in Germany, employment, Volkswagen, the German car maker, the guys who invented the Beetle, sold it all over the world, who were, the shining symbol of German car making, exporting it all over the world, also into China, one of their biggest customers, stopped hiring people. It usually hits the contractors first. But now they went one step further and said there will be no new hires. So people retire, will leave the companies. These jobs are not getting filled up again. Why? We had that weeks ago, Nick. They are completely suffering. Nobody wants to buy their bloody electric vehicles.
Yeah.
They're just sitting on the shelves. People are not buying it anymore.
Well, that's right. There's no there's a drop in the financial support from the government. So when the government support for the incentive that they gave people to buy an electric car falls off, so do sales. And then they go to the Chinese and say, hey, we got some electric vehicles here. Do you want some? And the Chinese say, well, actually, we do our own stuff over here. So thanks very much. But and by the way, why do your politicians slag us off all the time? So where do you go with all of this stuff? And here, then the conclusion, Einstellungsstopp, which means they're no longer hiring. It's a natural consequence. Slippery slope.
Yeah, well, it's got very slippery. I don't understand why everybody else sees that besides the guys who are in charge for industrial policies. Anyway, obviously this whole slagging of Germany has to lead to something, yeah? And we are a podcast which is discussing markets. So I had a longer term chart of the DAX on here starting in 2000. The green lines are obviously the recessions. And the interesting point is the recession line is not in the charts yet because that's always delivered after it really happened. And the official authorities, our equivalent to the Bureau of Economic Statistics, comes out with these numbers. We are already now in the third quarter of a real recession, Nick, right? In Germany.
Yeah, that makes sense. And I mean, so you're looking at, I guess you're saying, well, how does the chart go from bottom left to top right in an environment where it's absolutely clear as day that that this thing does not match with the economy of Germany.
Exactly. And if you look into the recession periods, which are not put into this chart, I just find it amazing. Obviously, it's not a day trading trade you put on here, but if you have a long-term portfolio allocation, this chart, because it hasn't done what it's supposed to do, reflecting the real economic situation. Stock markets are usually forward-looking. So they're always forward-looking, but they never see it coming. It seems to be, especially in Germany, true, that the investors have not realized what's going on. Yes, you and I on the channel a couple of weeks ago called the top pretty much in the DAX. And I'm not saying we couldn't also see a short-term year-end rally, but holy moly, if you ever wanted to sell a rip, as long as the politics are not changing in Germany, that's your last way out. Even if you're just a chartist, just put a line, an uptrend against it. We are going to test that sooner or later. So not a recommendation, because we don't do recommendations, our verbal disclaimer, but have a closer look at that, what you really think about Germany, who used to build power plants, machines and stuff, and now is delivering pizzas in the DAX. So I'm repeating myself. Meanwhile, in Italy, I love this slide on LinkedIn. It's called the Rich Session. And the Daytona SP3 model, 600 or 599 units only from Ferrari, has a starting price of $2.25 million US, and was sold out before its unveiling. Bless the Italians, I hope that would work for their whole economy. The only point which worried us a little bit was, what does that mean for society? You have a couple of really rich guys who actually don't care whether it costs $2.25 million or $3 or $1.5. They can do it anyway. Will they be safe in their Ferraris in the future, Nic?
Well, I mean, if they were driving around in Germany, I know they almost certainly won't be, because I continually see, people defacing Porsches over here. But I'd love to know which countries were the main buyers of these 599 units.
I would assume Middle East a lot,
Well, then I think they're pretty safe.
Yeah, exactly. Isn't that amazing? Isn't that amazing? Oh, I want a safe country. Yeah, let's move to the Middle East, to the rich countries. Yeah, you can leave your shit out in the street and nobody is punishing you. Meanwhile, in Germany, you say to your wife, darling, don't take the Porsche, take the Volvo.
Yeah. Yes, indeed.
Well, what are you going to say? Fine. So meanwhile in Italy, and then I thought maybe there's hope, in the United Kingdom. And I love this from the Daily Mail. Finally, a lesson in common sense. School tells parents it will not be providing litter trays for pupils who identify as cats, and warns this kind of behavior is not acceptable. It was new to me, so I did some research. Apparently, there's a big trend in schools in Great Britain, or the United Kingdom of Great Britain, Northern Ireland, that a lot of pupils identify as cats, which seems to be a thing. And obviously, there absolutely insaneness going on there. And for the first time now, officially, one of the good schools came out and said, no, we're not providing litter boxes for you if you self-identify as a cat. Cut it out. And I thought, okay, maybe there's some hope. Maybe some common sense comes back and we are not the end of the Roman Empire. And maybe the Brits might lead the way. But then I came across something else, and I handed over to you, Nic, because after now 28 weeks of working together on a Sunday, you've earned the right to have the absurdity of the week.
Yes, thanks very much. So Daily Mail news that cash-strapped council was spending 85,000 on weekly social care bill for just one child. That's 4.5 million a year. That's a lot of money. And the story actually goes into that this was council, I think Cambridge Council, and one of the teams looked into this thing and said, oh, actually, I think I can get the cost down. And with one fell swoop, got the cost down from 85,000 to 30,000. Now, no judgment. Obviously, this is a child with special needs. You don't have hundreds of these children in every council. You have only a few, but it does cost an awful lot of money. And I think the bottom line conclusion in all of this thing is, where there's money, there's always going to be private equity. So for sure, private equity, when they see governments paying an awful lot of money without sort of much care about how much they're spending, will always be there on the other side to take full advantage of it. But the question is, well, how did this team find 55,000 of savings without sort of depleting the services to this child? And that's a great question. And I think that is really the message. The message is, when governments tell you that they can't cut taxes because there's no money, what they're effectively saying to you is if the country were run in the way that it's run today, with money being spent without due care, then of course there's no money. But for sure, the bigger government gets, the more that it's likely to just be very inefficient with your tax money. And there's not enough of a scrutiny on this thing. So if they really wanted to sort of do something for the people of the country, they can look into all of these costs and be far more efficient than they are today.
Well, it's a nice business. I would like to get in. When my late mother died almost 10 years ago, end of life care. I did the calculation. I would have had to hire, because she needed somebody there all the time, I would have to hire 4 nurses full time. 3 who are on shift 8 hours, and then 1 backup nurse in there. Prohibitively expensive. So what did my sister and I do? We hired a qualified nurse in Poland who was living in, and at this time it was still legal, all officially on the books. But I was able to provide this service to have somebody there for the last month of her life. But these prices are just, you look at this and think, how great, I would say, how dare they do this with our money, Nic?
That's really the issue, isn't it? Because, the council, of course, have a budget. They raise taxes, whether it's in England, it's called rates or council tax. And then they spend that money. And then, of course, they say, okay, we've got special need kids, and each kid costs 1.5 million now with 30,000 a week. And we've got half a dozen of those. We need that amount of money and that amount of money. And then they just say, oh, this year we've managed to keep the rates at the same level. And they say, oh, in spite of the fact that inflation has gone up and all of this stuff. And you think they're doing a great job, but actually, still behind the scenes, government is just not careful with your money, and therefore, this needs to be much more scrutinized than it is today.
So does it mean even after Brexit, you're not becoming the next Singapore, Nic?
Well, whilst everyone is trying to pretend to be a cat, I'd say we've got no chance.
Holy moly. Good. Let's come to the good stuff. Why people are coming back. They want to listen to me asking stupid questions and you giving clever answers on the bond markets, because I'm just an equity boy. So I have a couple of very interesting slides in here. And you see the subline. It says a lot of standard deviations. And as an equity derivatives trader, I see these lines on the chart immediately. I can't stop my brain from focusing on them. And looking at the bond markets, there's a lot of stuff that came up. And there was a beautiful article in this week's Financials Times written by Toby Nagel. And he said, is this bond bear market rally worse than the 1970s? And I had to put the picture in. We see here a graveyard with gilts, bunds, JGBs, and treasuries. Complete disaster. And if you are a subscriber to the Financial Times, go on their website to this article by Toby, because he has an interactive graph in there. I just cut a couple of screens in here to see actually where we traded. This is the overall overview of the downturns of real terms in 10-year government bondholders, drawdowns from the peak. Yeah? And if you look at this line, it's at the moment we have Germany, UK, US, and Japan in here, all the big economies, going back to the 70s. And you actually already see the one standard deviation. Yeah, that's a drawdown here around 10-11%. That usually holds. Market will reverse. We had an absolute bloodbath in the 70s, yeah, and in the 80s, then in the United States and Japan, coming in where we went down to 3 over 3 standard deviations, and then we had normal markets since the 80s again. One standard deviation downturns, fine. Markets seem to reverse, and then Nic, I let you do the vamping. Where are we now in all these things?
Well, that's a great question. I mean, your previous slide is actually a classic because it's got sort of pictures of graveyards and stuff like this. And one thing I remember when I was first studying Elliott Wave is all about sentiment and what defines tops and bottoms. And usually, and this was not word for word, but how it was described. When people talk about the death of a market, that usually depicts a low in the market or very close to a low. And it's usually at the point when people start to say, this thing is going on forever, and then they introduce derivatives over derivatives. That's usually the top of the market. So it's actually quite a positive thing that they're coming up with the graveyard story, in my view. And I guess instinctively, this explains a lot of what is going on with the rest of the markets, with risk capital. Because if you have this big drawdown, then obviously you're getting a yield. We can talk about that, actually. I think you've got a good slide later, but I think what it's basically suggesting is, with a drawdown like this of historic proportion, where everybody is finally talking about the death of the market, it's most probably a good opportunity to go the other way.
It's actually interesting, in light of the conversation we had last week, there are a lot of economic reasons that it looks like a disaster, especially with what the Treasury does in the United States, and how everybody in the absurdity of the week, how everybody seems to be pissing money away. And then I have my trader's hat on and see these standard deviations. Germany, absolutely bloodshed. What else do we have on here? UK, absolutely bloodshed. United States, disaster. Only Japan is doing fine, or reasonably fine. They're at the one standard deviation at the moment, but hey, they control the yield curve. They can do whatever.
And absolutely, they control the yield curve. And fascinatingly enough, I mean, I'm of the belief that the Europeans and the US will go down the same route for pretty much the same reason. They've got a huge amount of debt, and they just can't afford this high interest rate for the government. I mean, you worry about 85,000 of expenses for childcare, which is at least 50,000 too much. And at the same time, you have 30 odd trillion of debt in the US, and you're just carrying on raising the cost of that debt for you. So what do? You have to act, and you have to intervene, and you have to control the yield curve. And very soon, and I think the only conclusion I can make, and I think I've made this before, is that the central banks can't be independent anymore. I mean, the government can't afford an independent central bank. Yeah. And what you saw over on Friday, I think it was Friday night, you had Moody's coming out and saying the US is now on watch for negative review. So effectively what they're saying, and they said, I think the wording they used was in the context of high interest rates. Well, what does that mean? That means whilst you're still jacking up the interest rates, and whilst interest rate costs are onward and upward of $1 trillion plus per annum for all of this debt, we've got to worry about your ability to finance this debt. And that's a very good question. It cannot be financed anymore, in my view, just by the likes of you and me saying, I think this is good for a trade. This has got to be financed by people who need this stuff and who want to put this stuff on their books, and not just for a trading view. And for that reason, the only thing you will end up doing is you will absolutely flood the system full of treasuries, and you will, restrict growth in your economy, because the money is going to the wrong place. It's not going for growth. It's not going for business. This is just going to service inefficient government. And for that reason, the Fed have to step in, and they have to cap the rates. And that's why I'd say, it's good for now until they do stuff like that. But after they do it, you want to be in risk assets again, because the risk assets will outperform.
Yeah, we mentioned that before. It really looks like the post-war period in the 40s in the United States.
Absolutely, where they capped interest rates at 2.5%, and equities outperformed bonds, by a factor of 5, 6, 7 times.
As I aptly named our little outfit, the tactical brief, if I look at this, look at the standard deviations, listen to you all the time explaining to me what cannot happen will not happen. It's exactly that point where we're going in. And I slip on another slide. It shows the hedge fund boost treasury shorts to records in here. Another point where you say, well, what the hell? Even if you think this system is completely overloaded on debt, and there's no chance in hell that they'll ever be able to, never mind paying it back, cough up the interest payments for this whole stuff. But from a technical situation, the market will be dominated by not any longer independent central banks. The whole market seems to be short for the good economical reasons we have agreed on. And now you think, what the hell? 3 standard deviations to the downside. We've seen that the last time in the 70s and the 80s. That's why I want to be long. What's the downside risk? Another 3, 4, 5 standard deviations? Yeah, might happen. But well, you know my old adage. Up to 3 standard deviations, the bell curve works quite nicely. If we leave that territory and go to 6, 7 standard deviation, it's a power function we have in there. And after 7 standard deviations, like the big crash in 87, on the old maps, they always show here be dragons. Nobody even knows what that is. Yeah? So pure chance, risk, reward. The whole market and its stock is short. We are 3 standard deviations down. We know governments have to do something. Probably what they want to do is being re-elected, take the independence from the central banks away, play the game they had at the end of 40s. End of story. Trade there. Set up. Agree?
Yeah, no, obviously we had a good test this week. There was a 30-year auction, which didn't go too well.
Yeah, I was about to ask you about that. I don't know too much about auctions. What happened there, Nic?
The Treasury have cleverly, and we've talked about this before as something they will have to do, and of course this is what they are doing. They've steered a lot of their refinancing into Treasury bills. And the good thing about that is that Treasury bills are easy to place. Money from bank deposit accounts, will just go into Treasury bills rather than earn the 1% what JP Morgan or whoever else will pay you for your money. And also, you've got a huge amount of cash stored in what's called the reverse repo account. And that reverse repo account has gone down sharply from 2.5 trillion last year to now just 1 trillion. And that's soaking up a lot of the short-dated issuance. And we know that the next 2 years, Treasury have to refinance something like 14 trillion or something of that order. So not all of these issuance, unfortunately, can go into the Treasury bill. So they still need to issue coupons, but they're restricting the amount of coupons that they issue. So 5-year, 10-year, 30. And last week we had a 30-year auction. And I think the size of the auction was something of around 20, 25 billion of that order. And the way that it generally works is that the primary dealers have to buy if nobody else buys, and central banks can come in there and go and bid directly. The primary dealers are the kind of the last bid, and there was what's called a tail, and a tail is basically sort of what was the range of bids for this treasury bond. The tail is quite irrelevant in some respects because the tail was something like 5 basis points, which is usually very wide for an auction. In other words, the price that was the lowest price that was accepted to get the 20-odd billion of bonds away. So 5 basis points. But immediately after this auction, where everyone saw the results, yields just shot up something like 20 basis points for the long bond, and that was just a sign and a warning sign to the US government.
That means, sorry to interrupt you here. That means they're offloading the shit immediately after they had to bid for it, yeah?
Yeah, or the hedge funds are coming in there saying, terrible auction, it's our worst fears that people aren't going in there saying, oh, this is a great opportunity to buy because yields are so high. They've all watched Torsten and Nic's video. They think there's a good story here for a trade. Oh, it's not working. Look at that. Yield, the tail is quite bad. So let's either short this stuff or let's hedge this stuff or whatever they're going to do with it. And yields just shot up after this auction. And as I say, it's a warning because the amount that the Treasury borrowed is absolutely a drop in the bucket to what they need to borrow over the next couple of years. And at the moment, as I say, they're steering most of it with T-bills. But when they go into something a little bit longer, they cannot accept a failed, or there's no such thing as a failed auction. Failed auction means they don't sell what they issued, but there can't be a failed auction because the rule of a primary dealer is that they're meant to bid, for everything. But that just means they can bid very low for this thing. The Treasury can't afford that, and they have to make sure that, especially over the next 2 years, they are continuing to provide support. And I think that's, that support can only come from the Fed. And that's why I believe the Fed can no longer be independent in this current situation of huge borrowing requirements, rising interest rates, and foreign banks or foreign investors not doing what they used to do prior to 2014. They're not, growing their demand for treasury paper as they used to. So they have to step in. They have to get the Fed to just buy this stuff, do what the Japanese did.
So our shite rate is still on track, yeah? When they need more money, when the recession eventually hits, they will pump down short-term interest rates, and we will have them leveraged up to the wazoo and enjoy them lowering short terms because, well, that's what they have to do in the first place to keep the ship running. While you were talking, I put the liquidity chart for the auctions on here.
Yeah.
It shows exactly that. We have, again, in terms of standard deviations, we are shooting up like crazy. It all gives us the sign we were discussing here. I want to come to the junk bond markets again. I came across a very interesting chart. Risky European companies pay highest borrowing premium since 2016 versus US. So you can see Euro high yield bonds is the pink line, and United States is the blue line. And that also fits into our analysis with the European market again, doesn't it, Nic?
Yeah, absolutely. And I mean, obviously, where there's lack of growth and everything that's going on in Europe right now, the Europeans are struggling to raise money at reasonable yield levels, and you can see just how much of a gap there is between US and Europe. And I think we were talking earlier about the impact of this thing, about money going into different areas. So there's a lack of IPOs, there's a lack of venture capital funding, and private equity is struggling to get financed. And, it kind of all makes sense in an environment where investors can actually get reasonable yields on equally risky investments, and more liquid, I would say, instead of having to lock your money up. So it's impacting all of this other risk capital just by virtue of the fact it's now offering returns which are very reasonable.
I was speaking to a seasoned bond trader about that earlier, and asked, so what is all this European junk about? How was the market in the past? And she said to me, it was very simple. There wasn't a market. There were barely any high yield issues. It was she called it the Italian phenomenon. And I said, what do you mean with that? And she said, yes, even interest rates were at zero. If you as a pauper went to a bank and said, well, interest rates are at zero, can I borrow some money? They would have told you, yeah, at 10%. Yeah, but interest rates are at zero. Well, then you can't have it. And that's what happened to the junk bonders over the very low interest rate period. So they went into private equity. They financed that whole crap. Bizarrely, I had to understand that now that interest rates are moving north again, these issues become attractive for people again, because finally you get some pickup for the risk you're willing to take.
Yeah, absolutely right. And as I say, by virtue of that happening, with one market now being large enough to be able to sort of take a lot of this risk money and absorb it, it's coming from somewhere else. It's coming from money that would have gone into IPOs. It was coming from money that would have gone into private equity or venture capital, and obviously it has its own consequences. Yeah.
Now, well, let's move on to the triple Bs. To the investment grade we have here. Another one which was screaming standard deviations in my face. US corporate bond spreads since 1920 on the left side. So we are at absolute lows, depending on spread. What does that mean? It simply means people are very trusty to triple Bs, right? They say, oh, yeah, fine. We have the government, which will always pay back because they can print the money. And what you have to put on top of that, let's not worry about it. So what does that tell me? Do I have to be long now, triple Bs, the investment grade bonds, or do I have to short them into a market like that? I can't really connect the dots anymore.
Well, according to the left-hand chart, which is the spread chart, and the right-hand chart is the absolute yield chart. So the left-hand chart is effectively saying you're getting a very, very tight spread to the government, to the government paper, whereas on the right chart, it's saying, well, it may be a tight spread, but you're getting a reasonable yield. So I mean, looking at the chart, and it's very difficult because they're on different time scales.
Yeah, one is going back
my
till
guess is
the
the
long
recent,
term, till 1850. Yeah.
Yeah, so the recent tightening in the triple B spread is probably a result of the fact that the underlying yield, so the government bond yield, has risen too much, if you like. So it's risen a lot. And you may well find that when yields start to go down, if yields go down in the government paper, the spread will widen. So the triple Bs will not do so well, whereas the government paper will do much better on a yield reduction.
And that will be my question, because the scenario we just explored and say, okay, if it's the post-war period of the 40s in the United States and the state simply does not offer you any yields, will the investor then be happy and say, well, I go and buy triple B and get a little pickup? Or will that lead to a shift in the markets that they say, wait a second, the government is screwing me over. Inflation is high, interest rates are low. I go into the corporate sector, I'm happy with a little pickup, or will they suddenly demand a huge pickup?
Well, again, that's it kind of depends on what your outlook is. If you think about I'd rather sort of not focus on what is the spread, rather to say how much return am I getting for my risk, and if I'm not covering inflation, then that's a big problem, right? So you've got to think about, well, even though I'm getting a reasonable pickup, if I'm still not covering inflation, then it's still not a good idea to be into fixed income. That's why I say for now, fixed income is a trade. And we really have to see whether or not the government are going to sort of take control of the Fed, whether the Fed are going to print, whether they're going to cap rates. It really does depend on your outlook for inflation, whether you like fixed income or not. What are the alternatives for you?
If I put the standard playbook together and say, okay, there will be a recession coming in the future, the spreads are extremely tight, especially on the triple Bs. Well, let's sell this crap. Huh?
Yeah, I mean, then you would be putting a trade. You basically say, I'd sell triple Bs, not buy governments.
Yeah. Good. So we've sorted that out. Another interesting slide, US borrowing costs. I found that interesting. It shows the US non-financial corporate net interest expenses as percent of GDI. That's pretty much GDP. The gross domestic income should be the same like product. One is prices, the other is value of the stuff. So from Deutsche Bank, Bloomberg Finance, and it shows surprisingly, but we mentioned that many times before, right? All these companies have been loaded up with cash, and at the moment they're simply refusing to refinance as long as we're at elevated levels. When is this going to hit us, Nic? Because sooner or later they will have to go to the piggy bank and say, okay, I have to roll it.
Yeah, absolutely. I mean, you're right. We've talked about it before, and the work that I've done on this thing shows that the US have probably been the smarter corporate treasury, where they have kind of locked in lower yields for longer, and so their refinancing horizon is quite long compared to other countries. But you rightly sort of note that currently, let's just say they're borrowing money at 3% for 5 years, and every bit of cash that they get, what they're doing is they stick it in the T-bill market or in short-dated, short-dated paper, and they're getting 5%. So their net interest cost is, well, in that example, it's negative, but let's just say they're not putting all of their cash into short-dated paper. So that's why you're seeing a reduction of interest costs today. And the question is, what is their refinancing profile? And we know that the type of organization in America is more interest rate sensitive the smaller a business you are. So Russell 2000 companies have a much greater exposure to refinancing risk over the next few years, because they couldn't go out there and borrow money for 5, 6, 7, 8, 9, 10 years. They could only borrow money for 3 years. So the Russell 2000 companies, if they manage to get away with it this year, where they don't have to refinance to next year they're going to have to refinance more, and a year after they're going to have to refinance more. So smaller companies are going to get hit much bigger than the larger companies, but American companies are going to be hit a lot less than other international companies who aren't able to borrow for such long periods in the capital markets.
It could again be a setup for a balance sheet recession, right? If companies can afford not to refinance, but to say, yeah, let's take all the money we have lying around in cash and redeem. We're not setting on growth now. We just want to save our backside by reducing our debt, and that will have again a horrible effect on the economy. See Japan.
Yeah, I mean, I think that's the issue, isn't it, really, for the government to choose, and they know what the refinancing problems for corporates, for individuals are, and what that impact is on their economy, right? So if they do nothing, then the economy will obviously suffer. And, that's why I believe this kind of whole higher for longer narrative is just, it's nonsense. The government can't afford it. Corporates can't afford it. People can't afford it. You've been at very low interest rates for too long, and the market is far too leveraged not to, at some stage, feel the pinch. And we know why they haven't felt the pinch this year. This chart explains exactly why they haven't, why high interest rates haven't impacted the economy to date. But there will come a time, and do the Fed really want to wait until they see things blow up before they act? And so I'm of the view that we're at the end of the cycle.
Now, you just mentioned the consumer. I have a chart for that as well, obviously, where we're fiddling the numbers again. Yeah? The consumers were apparently running out of money in the United States, and then there came a revision by the numbers. And it shows us they have another 400 billion, which they can blow out of the window over Christmas time, well into the first quarter. That would also be a little bit of an explanation why we see corporate earnings not really dropping, right?
Absolutely. I mean, that's exactly the whole point. Here is your reason for inflation, right? So they threw a lot of money into the system. They gave it to people. People ended up with, it says they're 2.1 trillion, and that 2.1 trillion, they're going out there and they're spending it. So the consumer is in jolly good shape. And when the consumer is in good shape, the corporates are in good shape. When the corporates are in good shape, they don't fire anyone. So things are going swimming nicely for now. And it doesn't matter what you do with interest rates. It is all to do with, how much money there is in the system. And that's, gradually getting used up. And when that money gets used up, or as it's getting used up, inflation falls. Nothing to do with interest rates. And so, this line obviously is, won't stay up there forever. And it's Christmas, as you say. They will spend.
It's actually quite interesting because what's will happening, and that's the perfect segue to the next slide, they will eventually run out of money. At the meantime, you can see the employment curve in the United States here, and it's a 24 moving average. We spoke about that last week as well. We are exactly now at this inflection point where the unemployment figures, are hitting the 24 weeks moving average here. So consumers running out of money, eventually they will have no money, while at the same time, the employment market shows first sign of weaknesses here. It doesn't draw a very good picture in what's about to come.
Yeah, I mean, I've been fairly sanguine about the growth, and, I've been non-believer in this recession discussion that's been going on for the last year, Twitter and all of this stuff. But I must say, for the first time already a few weeks ago, when you start to see these employment numbers, they really don't look clever. And if they really don't look clever, I must say it kind of fits with the kind of the bond view, if you like, where we are at the peak in rates or thereabouts. And for that reason, I don't believe in the higher for longer, and I am of the view that rates will come down faster than the market expects, and it's driven by this. This is the number that is critical, I think, for everyone. And let's face it.
Well, it's one of the mandates of the Fed, right? Employment.
Yeah, absolutely. And remember, 2024, you're coming into an election cycle. And I don't care who you are, if unemployment is rising in a year coming into an election, then as you're going to be straight on the phone to the Fed and say, "The hell are you doing?" Right? And therefore, this is a very, very important thing. And if unemployment starts to really rise off these levels, then you will have a recession, and then we have to see what the Fed do.
Let's have a look on the final chart with the standard deviation map on. It's US stocks versus rest of the world, going back to the 1950s. The light blue lines simply show the one standard deviation. And with standard deviation, it's very beautiful. You just put your ruler on, measure it, and then put another distance on top of it and another distance on top of it. We are now above 3 standard deviations, United States versus rest of the world. We discussed that as well. Cleanest shirt in the hamper, right?
Yeah, I mean, for now. And, they're the only government in the world that can grow by creating a budget deficit, an unfunded budget deficit. And of course, this is the consequence. The consequence is if your government is able to throw money into the system every year, the economy will grow. It won't grow as fast in the first trillion that you throw into the last trillion. So gradually all of this debt is having lesser and lesser and lesser impact, but it's allowing the economy to develop. It's allowing risk capital to come into business. And so money has been flooding into the state. But, I go back to your Brazil chart and I'd say right now, there are other economies that kind of are worthy of investment, and given the state of of geopolitics and what's going on with BRICS, this money that's been flying into the States, I'm not sure it's going to carry on flying in the same sort of rush than it used to be. Of course, we've talked about Germany. If you own Germany and you really don't like the politics, you go somewhere else for it. But, again, Germany is still very cheap versus, what you're looking at here.
Yeah, well, cheap stuff becomes usually cheaper. Anyway, so last look at
I knew you'd say that.
Golden times. Where did all the dollars go? Yeah, well, we discussed that in epic length. The moment they switched off the SWIFT system for the Russians, actually, I think they doomed their reserve currency status. That was actually the time when they really started picking up selling treasuries. The Chinese, the Japanese. The Russians can't because they've simply have been taking their money away. But in the Middle East, where this gentleman's agreement is, as long as you deliver weapons, we take all the petrol dollars and pump it into treasuries. They will also think twice about that, especially with the geopolitical situation now in the Middle East with Israel going on. And Steno Research put a lovely chart out of LinkedIn, and it's again China, international reserves in gold. Gold volume they were buying versus gold value they were buying. And what we see at the moment, in the gold chart, we are strangely in this iron coffin, which doesn't quite make it above the 2000 level for 5 years now. And is not really going down anymore. So what are the drivers for the gold price? A strong dollar is bad for gold. We have a relatively strong dollar. High inflation is actually good for gold.
Not necessarily, I have to say, sort of strong dollar and gold. I don't think the relationship is what it used to be.
Well, the next point I was coming to, I said high interest rates is actually bad for gold, because gold doesn't give you any interest rates. If you have real rates, that shouldn't be nice for gold in there. So we have this framework. I'm expecting if they lose their reserve currency status and we see interest rates are going down and we are in this long-term iron coffin. And the last slide, we see here the gold demand by central banks versus ETF demand into gold. Isn't gold actually the one asset which not tomorrow, I'm just calm your horses, all your gold bugs out there, but there should be a dramatic revaluation of gold in the future. Nic and I talked about that earlier when I was younger and he was younger in 2001, 2002, when gold was trading at $250. Now we're going 20 years into the future. We're trading at 2000. If I would use this analogy with all the scenario I've just threw into this hat, could it be that gold will be trading at $15,000, $20,000, $25,000 in 10 years' time, Nic?
Yeah, I think so. But I mean, obviously, 2001, 2002, Amazon was worth about $6, and it's now worth about $1,700. So
Oh, no. They did a couple of stock splits. It was actually, I had this chart
have you looked at
recently,
this?
30 cents or something. You would have made an absolute bloody killing.
So absolutely. So we can't say that sort of owning gold in 2000 was the best trade versus owning some of these other stocks. But I think the point you're making is a right one, that gold is far too low for the problem that it's trying to solve. And the problem that it's trying to solve is a place where you can put your money and feel comfortable with that, and not have it being manipulated by government or anything like this. And if you were invested in treasuries, sure, you earn interest, but also the supply of treasuries is increasing by 9% per year, whereas the supply of gold is increasing no more than about 2% per year. And so as a place to store value, if you like, that is certainly a sensible thing. And we talked over the last few weeks about the fact that gold could provide a solution for these governments with debts simply by revaluing their gold. And that puts gold, in my view, somewhere close to 20,000 rather than the 2,000 level it is today.
Yeah, no, I'm totally with you on that. So,
and Bitcoin, but we won't talk about Bitcoin.
So one last shameless plug for next week. Nic and I will have our first on-air threesome with Tim. Tim will show us his CPI modeling, and I can just recommend, have a look at the video that's already in the box, how Tim shows his approach. What we're going to do is we will analyze the three scenarios: CPI going up, CPI going down, CPI staying where it is, and what's the most likely outcome for the economy. Tim will dive into the math statistics behind it, and there are very interesting views already we can see. I'll just give you a little teaser. We're looking at the indication for systemic persistence of inflation. Will the secular trend we have seen over the last 20 years, always falling, be eventually exchanged, and gives the data as clues to think that could be the case? And we will also have a longer term look in the PPI versus PPI and all commodities in there, and that also gives you a very good historic overview. What will be the impact of the development we have at the moment, and can we derive anything out of that for the future? I'm looking very much forward to this video next Sunday, if we can line our ducks up and get everybody on board. The CPI modeling we are doing is, I think, well, yeah, I'm showing off a little bit. High-end stuff. A lot of hedge funds would be proud to have something like that on their books. So I just recommend, tune in, be our guest, and see, especially with PPI, CPI, retail sales coming next week, what we make out of the data and what we can take away to eventually set up a trade. Thank you. Nic, any famous last words?
I'm breathless.
So am I, mate. It's like there are so many good ideas out there. I have a couple of really high conviction ideas going on in my head at the moment. I think there is something brewing, a storm. There will be political actions furthering the market, even if, it's almost like price discovery, schmeiß discovery. Who gives a shit? Let's just the Fed do and the politicians what they do. And once we've identified the roadmap, we'll see where the prices are going. And that is pretty much a question of leverage, how much you earn, right? Or lose.
Yeah, I'm not a fan of leverage in the traditional sense. Not in your sense, of course. That's different.
Lovely. Nic, thank you very much for your time. I hope you like this little show. Then please like us, subscribe, and share with everybody. I think we are getting better every week, Nic, correct?
Well, I hope so.
Excellent. Last word. Thank you very much. Bye-bye.
See you. Bye-bye.